You might think your portfolio is safe, but lurking beneath the surface is a silent wealth killer, an overlooked factor quietly draining your returns without you even realizing it. It's sneaky, it's subtle, and it's hurting your long-term growth more than you think. Today, we'll uncover what this hidden threat is, how to spot it, and most importantly, how to protect your investments before it's too late. Don't let this silent killer sabotage your financial future. Today we will talk about the silent wealth killer hiding in your portfolio. So before we start, make sure to hit the like button and subscribe to my channel. The silent wealth killer hiding in your portfolio. Investors often focus on market volatility, poor stock picks, or economic downturns as threats to their wealth. But there's a subtler, often overlooked danger quietly eroding portfolio value: hidden fees and expenses. These charges may seem insignificant individually but compound over time, silently draining your returns. From mutual fund expense ratios to advisory fees, transaction costs, and hidden commissions, many investors underestimate their impact. Unlike market risk, which is visible and widely discussed, these fees rarely make headlines but can significantly reduce the power of compound growth. The silent wealth killer is especially dangerous because it's embedded in everyday investment products and services, often without investors fully realizing it. Identifying and minimizing these costs is critical to preserving long-term wealth and maximizing portfolio growth. How fees eat away at your returns. Even modest fees can have outsized impacts over time. For example, a 1% annual fee might not seem significant in the short term, but compounded over decades, it can slash total returns by tens of percent. This erosion is due to fees being charged regardless of performance, reducing the amount of capital working for you. High-fee actively managed funds, frequent trading, and costly financial advice contribute to this drain. Moreover, some fees are hidden in the form of bid-ask spreads or trading commissions, making it harder to track their total cost. Over a 30-year investment horizon, these seemingly small expenses can mean the difference between financial independence and a constrained retirement. Understanding the true cost of investing is a fundamental step toward building and preserving wealth. Common sources of hidden fees. Hidden fees can lurk in various investment vehicles and strategies. Mutual funds often charge management fees bundled into expense ratios, which cover portfolio management, administration, and marketing expenses. Exchange-traded funds, ETFs, typically have lower fees but may still incur trading costs. Financial advisors might charge advisory fees, often a percentage of assets under management. But some also receive commissions on products sold, creating potential conflicts of interest. Frequent trading generates transaction fees and tax consequences that further erode returns. Additionally, certain retirement accounts or brokerage platforms impose inactivity fees or account maintenance charges. Investors often overlook these incremental costs because they appear small individually, yet they accumulate significantly over time, underscoring the importance of transparency and vigilance. The impact of fee compounding over time. Compounding works both ways. Just as returns compound to build wealth, fees compound to diminish it. Consider an investment earning an 8% return annually. If 5% in fees is deducted, the effective return falls to 5%. Over 30 years, this difference reduces the final portfolio value by nearly 40%. The impact is more pronounced when fees increase or if returns are lowered due to market conditions. Even if the portfolio grows steadily, high fees can neutralize gains. Many investors focus solely on gross returns without accounting for these charges, leading to overestimation of portfolio performance. Understanding compounding's dual nature helps investors appreciate why minimizing fees is as crucial as selecting good investments. How to identify hidden costs in your portfolio. Identifying hidden fees requires careful review of account statements, prospectuses, and fee disclosures. Start by examining expense ratios for funds and ETFs, as these are typically stated as annual percentages. Scrutinize brokerage or advisory statements for transaction fees, advisory charges, and account maintenance fees. Look out for commissions embedded in certain investment products, such as insurance-linked securities or structured notes. Tax implications of frequent trading can be identified through capital gains reports. Investors should also be aware of bid-ask spreads, which represent indirect costs in buying and selling securities. Tools and apps that analyze portfolio fees can assist in uncovering hidden charges. Regular audits of investment costs empower investors to make informed decisions and negotiate better fee structures where possible. Strategies to minimize portfolio fees. Reducing portfolio fees is a powerful way to boost net returns. Opting for low-cost index funds or ETFs is one of the most effective strategies. These funds offer broad market exposure at a fraction of the cost of actively managed alternatives. Negotiating advisory fees or choosing fee-only advisors can eliminate conflicts of interest and reduce charges. Minimizing trading frequency reduces transaction costs and tax consequences. Consolidating accounts to avoid multiple maintenance fees and selecting no-load funds also help. Employing tax-advantaged accounts can defer or reduce tax costs associated with trading. Investors should periodically review their portfolios to identify and eliminate unnecessarily expensive investments or services. A disciplined approach to cost management can substantially improve long-term wealth accumulation. The role of transparency and investor education. Transparency and fee disclosure is essential to combat this silent wealth killer. Regulators have mandated clearer reporting, but investors must actively seek to understand what they're paying. Investor education plays a pivotal role in empowering individuals to recognize fee structures, ask the right questions, and avoid costly pitfalls. Financial literacy initiatives, fee comparison tools, and fiduciary advice standards help promote fair treatment and reduce hidden costs. Being an informed investor means challenging assumptions about investment products and seeking clarity on all fees. By prioritizing transparency and education, investors can protect themselves from excessive charges and ensure that their portfolios grow as intended. When higher fees might be justified. Not all fees are inherently bad. Some may be justified if they provide superior value. Actively managed funds charging higher fees may outperform benchmarks and generate alpha for investors. Specialized advisory services offering tailored financial planning and tax strategies can save money and reduce risk, offsetting their costs. Alternative investments with higher fees might diversify portfolios and improve risk-adjusted returns. However, investors must rigorously evaluate whether the benefits exceed costs. Guarding your portfolio against the silent killer. Hidden fees represent a stealthy threat to long-term wealth, quietly eroding returns even when markets perform well. Awareness, transparency, and proactive management of costs are essential to protect and grow investment portfolios. By understanding where fees arise, monitoring expense ratios, and choosing low-cost investment options, investors can significantly enhance their net returns. While some fees may be warranted for superior service or performance, vigilance is key to avoiding unnecessary charges. Ultimately, guarding your portfolio against the silent wealth killer involves education, discipline, and regular review, empowering you to keep more of your hard-earned money and achieve your financial goals. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.